Let's get back to HQ. David Faber, we promised, and David Faber, we delivered.
Thanks, Mark. And I may come back at you in a little bit and ask you some questions, too. I think I've reached the tipping point. It's been a long time, of course, 22 years following financial services, but I just don't know anymore. This B of A news may have sent me over the edge. Let's take a look, though, at Bank of America's stock price, because, frankly, you don't really care what I think. You want to hear maybe what I found out. Yeah, there's the $1 million challenge. Hey, look, down a lot, 17% today. That's a new low, a new multi-year low. What can we say? This is not my own reporting. Here I'm relying on the Journal and the New York Times, which are reporting that B of A approached the Treasury back in December when it was close to closing its Merrill deal and said, hey, you know what? We're going to have to take more write-downs there. We don't think we're going to close it. Now, was it a material adverse change? I have no idea. Step back a minute. Remember the night of September 14th? I was sitting right here when B of A agreed to acquire Merrill Lynch for, what was it, 0.895 shares, which amounted to about $29 per Merrill share. And many of us at the time said, really? Wow, what a great deal Merrill is getting. Why? Why? Why not have waited a couple of days when who knows what would have happened? But certainly Merrill was not going to be $29 a share. And then as it went on, of course, there were always some questions, and yet here we are with B of A saying, oh, yeah, you know, the markdowns apparently, and this is others reporting, were a lot more than we feared. Well, my question is, what are you talking about here? I mean, what are we really talking about when we say you didn't know or it got worse than you anticipated? The best I can do is to go to Merrill's third quarter earnings release and take a look at where they were marking a lot of what we would consider toxic assets. Now, I very well may be missing some things. Their U.S. super senior CDO portfolio was down to $1.1 billion in net exposure. All of this is net, by the way. They had hedges on the rest of it. It was still relatively small. All right, prime mortgages, $34.6 billion. Prime mortgages. Hey, B of A, you've made plenty of those. You know how to value them, right? Subprime related was down to $295 million in total net exposure. You want Alt-A? That's even less, $25 million. Residential non-U.S., $4.6 billion. That's a pretty big number, right? Who knew Merrill was making all those non-U.S. residential mortgages? And by the way, in commercial real estate, and there was some netting out here and some potential sales, not inclusive of First Republic's portfolio, but let's call it around $12 billion. My question is this. Is it really the Merrill assets? Is it really? Is that where the problem really was? I mean, you acquired Countrywide earlier this year, or I should say last year. That made an awful lot of subprime mortgages and Alt-A mortgages and toxic mortgages, didn't it? We don't know. I don't know. But I'll tell you what, Mark Haynes, at this point, since we've recapitalized the entire banking industry anyway, as U.S. taxpayers, maybe we should have just let them all go in the first place and let the ones who actually could survive pick up the pieces. I know many people will disagree, and that's a minority viewpoint. But what are we doing?
You know, I had this conversation earlier this morning with Jim Cramer.
On the street.
Out on the street outside the exchange, we ran into each other. And he and I were discussing, neither one of us had a strong opinion, but we were discussing that very question, David. You know, maybe we would have been better off just letting them go.
You know, many would disagree. You know, I would say, all right, we could have let Bear go, right? And then that week we would have lost Lehman and Merrill. But really, where are we right now? Where are we? We're nowhere. Free markets? I mean, are you kidding me? Trillions of dollars. We're recapitalizing the system. There were some good players out there. There were some bad actors and good actors. We're not allowing the good actors to actually get what they deserve, and we certainly haven't allowed the bad actors to fully take on all the risks, or I should say the result of all the risks that they took on.
Yeah, you know, I wish now that I had thought of it at the time. Well, we should have given money to the bankers who were not in trouble. We should have given money, capital, strengthened the bankers who did not make the mistakes.
And then bankrupt the ones that did,
and
do it in an orderly way, transfer the assets, get new managements. I don't know. Listen, many people will disagree. There's no clear answers here. But where are we right now is the only thing I ask.
There was no choice, though, with Lehman. If you think about the political environment at the time and the moral hazard thing, they had no choice but to let that fail. Looking back, but I mean, think about it.
I don't know.
They bailed it out.